Hi, Else here, and in this video we'll be exploring the Statement of Comprehensive Income under IFRS. Remember, in our last video we covered the income statement, which provides users with a measure of profitability. The profit or loss at the bottom of the income statement is used as an opening number in the Statement of Comprehensive Income. This statement then adds or deducts more complex items, which are, as yet, unrealized. This includes gains and losses from foreign currency and adjustments to value other assets and liabilities at fair value rather than historical cost, as well as other items which are left for more advanced accounting courses. The Statement of Comprehensive Income provides a broader definition of profit or loss, one that includes both realized and unrealized amounts. In order to understand unrealized, we'll compare it to the concept of realized. When you sell a service, the sale is in the past. Your company has provided the service to the customer already. Revenue from that sale would go on the income statement because it's realized. It's in the past. What if a company bought shares in another company? The value of the shares when they were purchased was $950,000, and that would go on the statement of financial position as an asset because it has future economic benefit to the company. What if, by the end of the year, those shares had declined in value and were only worth $800,000? That would be a loss of $150,000, but because you still hold the shares, the loss is unrealized. It's a paper loss, not a realized loss, because you have not sold the shares as yet. That unrealized loss, net of taxes, would be recorded on the Statement of Comprehensive Income. Unrealized gains or losses are amounts that have not been realized because we still own or control the item that has caused the gain or the loss. Now let's look at the structure of the Statement of Comprehensive Income. Again, the statement starts with a heading, which must always include the company name, the title of the financial statement, and the time period covered. The Statement of Comprehensive Income then lists the profit, or loss if the company's expenses are greater than their revenues, from the income statement first, followed by any other comprehensive income items. Here I've used the example of foreign currency and fair valuing investments. All the other comprehensive income items must be listed net of tax. This means that any applicable tax amounts have already been deducted. Here the other comprehensive income items are an overall gain, but they could have just as easily been an overall loss. These amounts, added or deducted from the beginning profit or loss amount, are equal to total comprehensive income. Again, remember that other comprehensive income amounts are unrealized gains or losses. Pause the video to answer this check your understanding question. IFRS requires the Statement of Comprehensive Income to be. The correct answer is C. A corporation may decide to combine comprehensive income and income in one statement or have two separate statements, as I've shown in this video. Why does IFRS require a Statement of Comprehensive Income? The developers of IFRS felt that unrealized gains and losses of a corporation could have enormous impact on user decisions, and by ignoring these amounts, user confusion would result. By adding or deducting these unrealized amounts from the more traditional definition of profit, users would have a more comprehensive representation of income in order to make decisions about possible future outcomes. Remember that profit, or loss, from the income statement is the opening balance in the Statement of Comprehensive Income. The income statement is therefore connected to the Statement of Comprehensive Income. How is the Statement of Comprehensive Income connected to the other financial statements? The amount or amounts of other comprehensive income is used in the Statement of Changes in Equity as part of the accumulated other comprehensive income. So, again, the order of the statements is the income statement first, the Statement of Comprehensive Income next, and then the Statement of Changes in Equity, which we'll be covering in an upcoming video.